All right, let's talk about Google. Specifically, we're going to try and crack the code on how a company gets to be worth, well, a truly mind-boggling amount of money. We're going to figure out exactly what the market is thinking to justify a price tag this massive.
Just take a second and look at that number. $3 trillion. It's a figure that almost doesn't feel real, right? It's so huge it's hard to even wrap your head around. I mean, that's more than the entire economy of most countries on the planet. So, how on earth do you get there?
And that's really the core question of this whole explainer. Think of us as financial detectives. The $3 trillion price is our mystery, and our job is to dust for fingerprints, to uncover the clues, all the beliefs and expectations that the market has baked into this valuation.
So here's our game plan. We'll start with a big question. Then we'll look at the historical evidence, decode what the market is betting on, and reveal the one number that's at the heart of it all. After that, we'll see how Google compares to its rivals, and then the final verdict is going to be up to you.
Okay, let's dive right in. The stage is set. The mystery is clear. What kind of story does the $3 trillion price tag actually tell us?
You know, any good investigation has to start with the facts. And in the world of finance, the most important fact is cash. So let's start by looking at our first set of clues, Google's track record for generating cold, hard cash over the last 10 years.
We're going to be laser-focused on a metric called free cash flow, or FCF. The easiest way to think about this is that it's the actual cash a company has left in its pocket after paying for everything it needs to run and grow the business. It's kind of the purest measure of a company's financial muscle.
So let's look at the evidence here. Back in 2015, Google pulled in about $16.5 billion in free cash flow. Fast forward to 2024, and that number rocketed up to nearly $73 billion. That is a huge increase, more than 4 times bigger. But look at the growth column. The path to get there was anything but a smooth ride. You see these massive jumps, but then you also see years where the cash flow actually went backwards.
And this chart right here really drives that point home. I mean, look at that volatility. You've got these incredible spikes in growth, but also years where it dipped into the negative. For our investigation, this choppiness is a really, really important clue.
So, to quickly sum up the historical evidence, the cash machine is absolutely incredible, growing more than 4-fold in a decade. But it's been a bumpy ride. Those dips were often because Google was spending a ton of money on things like new data centers to power things like AI. And crucially, the most recent growth we saw was a pretty tame 4.7%. Remember that number, it's going to be important.
Okay, so we've got our historical clues. Now we need a tool that can help us figure out what the market is thinking about the future.
And that tool is called a reverse discounted cash flow analysis. Now I know, it sounds super complicated, but the idea is actually really simple. Instead of us trying to guess at future growth to figure out what a company should be worth, we take the price, that $3 trillion, and we work backward to find out what growth rate the market must be expecting to get to that price.
It's basically a 3-step process. First, you start with what you know, the $3 trillion price tag. Second, you plug in a couple of standard financial assumptions, things you need for the model to work. And third, once all that's in place, you solve for the one missing piece of the puzzle, the annual growth rate that makes all the math work out. And that brings us to the climax of our investigation. This is the smoking gun clue that tells us everything we need to know about what the market expects from Google.
So, the number that unlocks this whole mystery is this right here, 13.5%. This is the answer that our little calculation spits out.
But what does this number actually mean in plain English? It means that for Google to be worth $3 trillion today, investors as a whole believe it can grow its free cash flow by an average of 13.5% every single year for the next 10 years straight.
And this right here, this is where our investigation gets really interesting. On one side, you have the market's bet, 13.5% growth needed. On the other side, you have the recent reality, 4.7% growth delivered. That gap, the gap between expectation and reality, that is everything.
This gap tells us the whole story. The market is not betting on more of the same. No way. It is making a huge explicit bet that future technologies, we're talking AI, we're talking Google Cloud, are going to kick growth into a much higher gear, a pace that's almost 3 times faster than what we've just seen.
So, the big question is this 13.5% bet completely crazy? Well, to figure that out, we need some context. Let's see how Google's valuation looks compared to its neighbors in the big tech world.
If we look at a classic valuation metric, the price-to-earnings ratio, we get some really important perspective. Google's PE is about 27. Now, that's high compared to the average stock for sure, but look, it's actually lower than Microsoft at almost 37 and Apple at nearly 35. So, believe it or not, compared to its biggest rivals, you could argue it's the most reasonably priced of the bunch.
So what does this comparison tell us? Well, yeah, Google is definitely expensive compared to the average company out there. But in its own league, the league of tech titans, its valuation isn't some wild outlier. It's priced right there with its peers. And on some measures, it even looks a little more attractive.
And that brings us to our conclusion. We've gathered the historical evidence, we've decoded the market's hidden bet, and we've put it all into context. The evidence is all in, so now it's your turn to be the judge and jury.
And it all boils down to this one simple question. After seeing all the evidence, do you think the market's assumptions about Google's future growth are realistic?
You can really look at this two ways. A skeptic looks at that 13.5% and says, no way, that's a huge jump from the recent 4.7%, and their growth has been all over the place. But a believer looks at things like AI and the cloud and says, oh yeah, those are game changers. They can easily power Google's growth well past that 13.5% target.
And ultimately, that's what that $3 trillion price tag is all about. It's a bet on the future. The question you have to answer for yourself is this: will Google's biggest technological bets, AI and cloud, be big enough to deliver on that 13.5% promise? The market has placed its bet, and now you know exactly what it is.